Most people try to win in crypto by buying lows and selling highs, but what if the real money is made in between those trades? This is a story of a trader that turned $608,000 into 1.5 million, not by betting big, not by timing tops and bottoms, but by becoming something the market depends on, a liquidity provider. He didn't vanish, he didn't YOLO into a meme coin, he just played the long game and mastered the art of being useful. So here's a story of the quiet trader that nobody saw coming. And this isn't just a story of a crypto influencer or a hedge fund. It started on a quiet thread on a DeFi forum with a user who claimed to have made 7 figures without even taking a directional bet. He didn't give a name, just a strategy. He wasn't trying to be famous, only helpful. What caught everybody's attention was his claim. He started in late 2021 with just $6,800, deploying it on a decentralized exchange as liquidity, saying, "I didn't try to time the market, I just made myself useful to it." He wasn't chasing alpha, he was providing infrastructure and getting paid every time someone used it. So let's break down what he actually did. Most people think of market makers as giant trading firms, Citadel, Alameda or Jump. But in DeFi, you don't need to be a whale, you just need to have capital, patience and a good strategy. Here was the setup. The platform is started on Uniswap v3. Then expanded to Balancer, Velodrome and Ambient Finance. He used to use pairs focused on high volume, low volatility pairs like Ethereum versus USDC, wrapped Bitcoin versus Ethereum, and stable pairs like USDC DAI. The method he used was a concentrated liquidity ranges, narrow bands around the current price to maximize fear capture. And the tools he used to use bots to monitor prices and rebalance ranges as the market shifted. But the most important is that he compounded everything, the rewards, the fees, the incentives, redeployed daily. Instead of trying to win the lottery, he created his own yield machine. Every day, hundreds of trades moved through the pools he helped fund. Each trade paid 0.3% in fees, and his share accumulated. At the first, obviously, it was slow. The first week he made $27, first month he made $138, the third month he made $519, but by month 9, $4,300 was his monthly renew. And obviously he is the big power of being the middleman. Why did this work so well? Because while traders take risks, market makers earn every time a trade happens, regardless of price direction. The actual trader called it building a toll booth on blockchain. And during DeFi Summer 2.0, something massive happened. DEX and new chains were competing for liquidity, so they launched an incentive program, token rewards for LPS. And the best part, that he was early. He moved to chains like Arbitrum, Optimism and Base before the masses, and deployed LP on the launch day, farmed airdrop multipliers, token emissions and governance bribes. Sometimes the rewards were bigger than the fees, sometimes both were massive. Here's a breakdown on how the 1.5 million stacked up. So from the sources we have, an estimated value were trading fees, he had 430,000, protocol incentives with 680,000, governance token gains, he had 200,000, early airdrops about 90,000, and referral rewards was about 100,000. And all this happened without leverage, without memes, and without ever selling the top. But we must say that the biggest edge he had was extreme discipline. He never provided liquidity to volatile or narrative driven coins, avoided anything with low TVL or sudden spikes, deployed on battle-tested protocols only, used impermanent loss protection protocols like Gamma, Arrakis or Uniswap v4 hooks, and obviously automated everything via custom bots just like Defi Yama's Lipi dashboard and Revert Finance. He obviously treated it like a business. Making money isn't sexy, but it prints. By month 15, he was already earning $20,000 per week passively. And instead of aping into the next hype coin, he started gradually pulling profits into stables and real world assets. He didn't need to win the moonshot, he just needed to keep the machine running. But obviously this strategy isn't risk-free. He faced things like impermanent loss. If Ethereum moved too far, too fast, he would lose relative value compared to just holding, as well as the smart contract risks. A bug in a DEX or LP protocol could wipe him completely, as well as a de-incentivation risk. Protocols like Velderum and Balance change tokenomics often, cutting LP yields, and obviously the exit liquidity traps. Some small cap projects use liquidity rewards to dump their own LPs, but by staying diversified and monitoring protocols actively, he avoided major losses. And the last things we know that by mid 2023, he had 1.3 million across wallets, all from liquidity. He wrote one final post. It wasn't flashy, it wasn't luck. I just showed up every day and provided what the market needed. So what was the final line of his thread? Next time, I'll be the one paying LPs. You'll see. So please, if you learned something new about liquidity, hit that like button. Comment liquidity gang if you want us to make a tutorial on how to start with $500. And subscribe, because in this space, being useful is more powerful than being loud. And remember, in the world chasing dopamine and hundreds of pumps, the quiet wins still work.